Yes, so in our previous class, we were looking at borrowing costs. So borrowing costs, if you look at your syllabus, hope you have the syllabus. I think I shared the syllabus some time back. If you look at your syllabus, that is under topic number 2. That is under topic number 2. What we covered last time, borrowing costs, is actually under topic number 2. Topic number 2, where we looked at how you can actually end up having to account for what we call borrowing costs. So that is, for example, interest, legal fees, flotation costs. But majorly in this case, we delved at how you can actually end up having to deal with the interest as a borrowing cost, how you account for it, for it. So we said in this case, if we have borrowing costs that have actually been incurred during the period upon which the amount borrowed was having to be utilized for long-term projects. So for long-term projects, so for example, in this case, for coming up with qualifying assets, for example, coming up with a building, then the interest that the reporting entity pays during that active period of construction should be included as part of the cost of that particular qualifying asset, And we looked at, I think, 2 illustrations regarding as well in this case, you can actually end up having to account for borrowing costs, So still in the same area, that is topic number 2. I want us now in this case to look at construction contracts, how you end up having to account for construction contracts. So long-term construction contracts as per International Accounting Standard number 11, International Accounting Standard number 11. So just from the term construction is supposed to accounting for construction contracts, accounting for construction contracts, accounting for construction contracts, for construction, accounting for construction contracts, accounting for long-term construction contracts. So when you talk about, in this case, long-term construction contracts, these are simply contracts that involve construction projects, Maybe in this case, you are a contractor and you've actually been called upon, in this case, to undertake construction of a long-term project. Let's say, for example, in this case, an apartment, a building, a road. So there's a way as to why, in this case, you'll actually end up having to undertake your accounting as the contractor. You are accounting as your contractor. For example, in this case, if it is involving a construction project, in this case, for this kind of project, which is actually long-term in nature, it is that they might actually end up having to take, like, let's say, for example, now in this case, maybe 5 years. So they can take, let's say, for example, in this case, 5 years. So already, maybe in this case, you've already determined maybe the contract price. So you as a contractor, you've already told, in this case, your client that the entire contract, you'll end up having to pay me, let's say, for example, 6 million. So you'll end up having to pay me 6 million. But of course, now in this case, this 6 million won't actually be paid entirely, in its entirety. So maybe in the first year, they'll pay maybe in this case 1.5 million. The next year, they pay maybe 0.8 million. The other year, they pay maybe in this case 0.7 million. So it will be like that until conclusively at the end of the 5 years, in this case, you can actually be able to determine as to how much in this case would be the total. That is 6 million will be paid by the end of the 5 years. But the amount wouldn't be paid once, So in accounting for long-term construction contracts, the question would be, what will end up having to determine for us to say, for example, in the first year, then we are going only in this case to pay, in this case, only 1.5 million. Or in the second year, we are going to pay in the contract price only 0.8 million. So what you're going to discover out of this particular topic, it is that there's a procedure, or in this case, there's a way as to why in this case you can determine whether you'll end up having to pay 0.8 million or 0.7 million or 1.5 million in the different years until the entire contract price has actually been paid. Maybe it can actually end up having to be dependent upon the completion of work. It can end up having to be dependent upon the completion of work. Let's say, for example, in the first year, maybe you've actually completed maybe 30% of the work. So you've completed 30% of the work. So maybe this could be the determining factor. So they take 30% of the entire amount, then they pay you that amount, which will likely be 1.8 million. like that. 1.8 million, like that. Is it 1.8 million? Yeah, so they'll pay you in the first year because you've completed what? Only 30% of the work. So that is what will determine, for example, in this case, as to how they'll end up having to pay the contract price for the different years. So there are different types of contracts, of course, now in this case that can actually be undertaken. So which are going also in this case to end up having to look at. But before in this case, we go into how you can actually end up having to come up with these computations or presentation of these financial statements. Maybe in this case, we can just be able to look at some of the key terms that are normally involved in what you're calling what construction contracts, or as per International Accounting Standard number 11, what are the key terms that are very important whenever you're having to account for long-term construction contracts, long-term construction contracts. So we can briefly just indicate, before we start looking at computations or presentation of financial statements, we can briefly just be able to indicate, so definition. So definition of long-term construction contracts. So definition of construction contracts. Definition of construction contracts. What are these construction contracts? Definition of construction contracts. Definition of construction contracts. So these are contracts which take a period of more than, so long-term, in this case, long-term, you can say long-term construction contracts, long-term construction contracts, long-term construction contracts are ones, contracts are ones which take a period of more than a period of more than 1 year, a period of more than 1 year, a period of more than 1 year, a period of more than 1 year. So the contractor here, so there'll be two parties here. There are two parties in this kind of a contract. There are two parties. So i.e. the contractor and the contractee. The contractor and the contractee. So the contractor is the one who's having to undertake the construction of the long-term projects. The contractee is the client, whom in this case the contractor is having to serve. So maybe in this case the contractee has called upon the contractor to construct what? Maybe a road or maybe a building. So there are two parties here, the contractor and of course now in this case what? The contractee. The contractor and of course now in this case what? The contractee. So our main purpose here is just for us to be able to understand, for example, how do we determine profit under the contract? And of course, in this case, how do we value the work in progress? How do we value the work in progress, which eventually ends up having to become like an asset in the books of the contractor? So the main objective for accounting for these contracts, the main objective as to why we will account for this kind of contracts, the main objective of accounting for long-term construction contracts, the main objective for accounting for long-term construction contracts is, what is the main objective as to why in this case we'll account for such kind of contracts, that the contractor has actually been given and it takes a period of more than 1 year to undertake such kind of projects. Number one, through the presentation of like an income statement, because you're going to look at two key statements that are normally prepared. So the income statement and of course the statement of what? Balance sheet, or the balance sheet statement of, for example, in this case, the statement of financial position. So through the income statement, when we're accounting for this, then we can be able to determine the contract profit. So we'll be able to determine the contract profit for each accounting period. The contract profit for each accounting period can be determined. So the contractor here, once he presents the statement of profit, then he can know how much he has made as a profit on this contract. So remember, they would have already agreed like the contract price before they even commence. But you've said this contract price will be paid maybe dependent upon the completion of work. So if it is 5 years, in the first year, we must be able to determine, for example, how much was he able to realize as a profit as a contractor. Remember, the 6 million, of course, is having to be paid differently, so in different proportions for each and every year. But how will you be able to know, like in the first year, when they paid him that 1.8 million, whether he made profit in that year or it was a loss? So that is what you're going to, in this case, for example, determine how you come up with a profit for a contractor who has actually been engaged in a long-term construction project. Number two, we'll be able to determine what we call the work in progress. The work in progress. What you'll end up having to realize here, the work in progress now will be, like in this case, an asset to this particular contractor. So he already has work to be able to undertake that is still likely what? In progress. So therefore, in this case, we'll be able to determine now, in this case, the work in progress. So the evaluation, also the main objective as to why we account for this contract, is for us to get the evaluation of the work in progress. The evaluation of the work in progress. And of course, you're going to see how we determine these two, the evaluation of the work in progress, or what we call WIP. So we'll see how in this case you come up with the contract profit, and how in this case you value the work in progress through the statement of financial performance or statement of financial position, So that is, in this case, ideally, in a nutshell, what we actually mean by a construction contract. So this kind of contracts, we can have a number of types of this kind of contracts. There are a number of types of this kind of contracts. So for example, in this case, number one, we can have what we call what? So the types of this kind of contracts, the types. So number one, we have a fixed price contract, a fixed price contract, a fixed price contract. We can have what we call what? A fixed price contract. So what is a fixed price contract? It is one that the contract price is determined before commencement of the work. So you can be able to write in simple terms, it is one where the price is determined before the commencement of the work. It is one where the price of the contract is determined before commencement of the work, before inception of the contract. So you fix the price. It's like in this case, the price is actually fixed. But now in this kind of a contract, they can include a clause, which we call an escalation clause. Maybe in this case, you could have ended up having to fix that you as a contractor, you've already done your evaluation of what is required to undertake this kind of work for your client. You've realized maybe in this case, by the end of it all, it will be 7.5 million. But now you never know. So things might end up having to change. So the cost of labor can increase along the way because it is a 5-year contract. The first year, maybe you are paying, in this case, watu wa mkono, ulikuwa unawalipa 300. After 1 year, in this case, the economic conditions have actually changed. Watu wa mkono wanadai, in this case, walipe 600. So it doubles. So, of course, you can be able to fix the price like this, but along the way, things might end up having to change. So rather than having to be tied as a contractor, in such kind of a contract, what is normally included in is what we call an escalation clause. An escalation clause actually enables, now in this case, the contractor and the contractee to be able to adjust even the contract price whenever the work is actually having to progress. So we can have, in this case, of course, a fixed price contract. It is one whereby the price of the contract is fixed before the commencement of the work, or a commencement or inception of the contract. But you're having to say an escalation clause can be included. So you can be able to say an escalation clause can be included. an escalation clause can be included. A clause is like a paragraph. It can be included in this kind of a contract. An escalation clause can be included to enable adjustment, to enable adjustments, to enable adjustments, to enable adjustments, to enable adjustments. Whenever, for example, there is any adjustment needed, then that clause will give the leeway. So it won't just be static 7.5 million. So he can go back to the contractee, they try to adjust. But in this case, in simple terms, that is what we mean by, in this case, what? A fixed price contract, a fixed price contract. Then we have now, in this case, another one in this case, number two, you can be able to write. So the first one we've said is a fixed price contract. Then number two, we have now in this case, cost plus contract, a cost plus contract. So number two type of contract, So we have in this case what we call a cost plus contract, cost plus, like this, cost plus contract, cost plus or percentage rate or percentage rate contract. So it is the opposite of this other one. So this one, you know, it is fixed in advance, but this one you can be able to see. So cost plus, but in this case also there is what you're calling what percentage rate, or we can be able to call it what a percentage rate contract. So it is a contract where the contract price is only determined after the contract has been fully completed. So it is the opposite. So after you've been able to complete the work is when now the contract price will likely be determined. It is one where the contract price is determined after completion of the work. After completion of the work, it is one where the contract price is determined after the contract has been fully, after the contract has been fully, performed, has actually been fully performed or completed, So hii tukianza contract tushaeka price, hii tutangoja kwanza. So the contractor says, I will not actually pay you until you do all the costings after the work has been completed, is whereby now in this case I can actually end up having to pay you. So the owner in this case assumes what? Most of the risk. So the contract price is equal to the cost incurred plus agreed profit margin. So in this case, for us to be able to know the contract price, how the contract price will be determined here. So the contract price will be equal to, the costs that were incurred, you add on it. You as a contractor now, in this case, there are those costs you incurred. It could be labor, so in this case, you actually assume all the risks as the contractor. So the contractee here may relax to, anangoja hiyo building ishe. Then ukishamaliza umespend pesa yako yote, unakuja unamwambia nilispend. In this case, how much? This much. So for example, in this case, you would have spent everything, materials and labor, maybe up to in this case, 6 million. But now in this case, remember you are in business as a contractor. So you are looking forward to having to do what? To make a profit. So therefore, in this case, to know the contract price, you'll be able to charge the contractee. Ili utamwambia lipe, kuna cost of the materials, labor and everything, it is 6 million. But on this cost, you likely end up having to put on what? A profit margin. So in this case, that's why you're having to say cost plus contract. So you determine all the costs you would have incurred as a contractor, then unaeka margin yako. So I don't know how much you'll end up having to put as a margin. Maybe you can say 30%. You can say 30%. So maybe it can be, for example, in this case, 30% of this, which ends up having to be 1.8 million. So in total, the contract price will be 7.8 million. 7.8 million, like that. So that is ideally what we mean by, in this case, a cost plus or a percentage rate contract. So now in this case, we can go as to how we end up having to account for this kind of contracts. How do we account for them? So the methods of accounting. How will you account for them as a contractor? The methods of accounting for this kind of contracts. So the methods of accounting. So there are two major methods. There are still two major methods as far in this case you can actually end up having to account for this kind of contracts. So you have the completed contract method, and you have in this case the percentage of completion method. So the completed contract method, majorly here, you'll actually end up having, in this case, for example, determine the contract cost, and in this case, determine the contract price. The difference in this case will give you a profit margin. Remember, we've said in accounting for long-term contracts, there are two major objectives you are looking for. You are looking to be able to determine how much you've made as a profit as a contractor for each and every year. Number two, you are looking at, in this case, having to know at the end of each and every year, what is the work in progress I'll be continuing with the coming year. Because you are saying, for example, the contract would be 5 years. So in the first year, you want to know, how much have I made as a contractor in terms of profit? By the time I'm going to the second year also, how much am I carrying forward as the work in progress to continue the second year, third year, fourth year, up to the fifth year? So that is what the main objective, as why in this case, we are looking into accounting for this kind of long-term contracts. So you're having to say one of the methods that in this case will be utilized in terms of accounting is the completed contract method. Ideally, in this one, you just get the difference between the contract price and the contract cost to be able to know the profit margin, because the profit margin or the profit is our main reason as to why we are accounting for this kind of contracts. So to determine the profit under the completed method, you get the contract price, which you've already been able to set as a contractor. Then you minus the cost you've incurred on the contract to know what could be your profit that you've actually made in each and every year. So what are we saying? So you can be able to write methods of accounting. Methods of accounting. So we are almost starting now to do the mathematics. The most interesting part is how you do the mathematics. What we are talking about is just a lot of stories. You might be wondering, what are we saying? But now, before we start computations, very important, we say these stories. So methods of accounting for construction contracts. 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 So method number one, we've been able to say the completed contract method. Completed contract method. Completed contract method. The completed contract method. The completed contract method. Then you can write one sentence about it. What do we mean by this? So it is where the revenue is only recognized after the contract has been completed. Is one where revenue is recognized. Revenue is recognized after the contract has been completed. After the contract has been completed. The revenue is recognized after the contract has been completed. That in this case, you'll only be able to realize revenue. You'll be paid. You'll be paid as a contractor. You'll see that revenue when the contract has done what has actually been completed. So the profit is recognized as follows. The profit is recognized as follows. So how will you determine the profit? What have we said? The main reason as to why we are looking into accounting for this contract is, number one, for us to know what is the profit I'm making as a contractor, and also what is the work in progress. So under the completed method, as I've explained earlier, for you to know what is your profit, what will you be able to do in this case? So the profit here, the contract gross profit will be equal to, gross profit is normally determined, this is equal to, it will be equal to the contract price, you minus the contract costs, So what you'll be receiving as revenue, because you're having to say only after it has actually been completed, is when you'll be able to receive revenue and recognize it. Of course, in this case, the revenue here will be what you had charged as the price, contract price. So utalipwa kama revenue. But uta minus zile costs ulikuwa umeincur as a contractor for you to know what could be your gross profit. What could be your gross profit? Could be your gross profit. Could be your gross profit. Could be your gross profit. So that is in this case what you mean by the completed contract method, the completed contract method, completed contracts method, completed contract method. So in this case, this particular method can be applied majorly where, for example, it is not easy to estimate like the costs of the entire contract before you undertake the contract. You must be able to just complete the contract for you to be able to know, for example, what could be the total costs I would have incurred. There are those contracts that sometimes it is a bit difficult to be able to value, even what will likely be involved in for each and every cost item that in this case is having to be utilized in that kind of a contract. For those ones, you cannot determine, for example, the contract price in advance because you don't know the exact costs. So therefore, in this case, you'll end up having to adapt the completed contract method to account for it, to know what could be your gross profit as a contractor. So you can't predict, you can't even tell, you can't even value the costs before you complete the work. So you'll adapt this method. You'll complete first before, in this case, you end up having to say, maybe this could be what I can be able to charge as a contract price after being able to, for example, put a margin on what I incurred as the costs, So it is utilized majorly where it is very difficult to end up having to determine what could be the contract price or what could be the cost involved in the contract before the contract is performed, So method number 2, percentage of completion, which is the most common and is the one in this case we are going to do the interesting mathematics. So method number 2, it is percentage of completion. That is another method that is used to account for these contracts. So percentage of completion method. So method number 2, percentage of completion. Percentage of completion method. Percentage of completion method. Percentage of completion method. So this one, in this case, you end up having to determine the price and the costs depending upon what percentage have you been able to, for example, complete the work. What percentage have you ended up having to, for example, in this case, end up having to do what? Complete the work. To be able to know, for example, the percentage as to how much you've been able to complete as work, you can, for example, maybe in this case, you already know the total costs. The total cost to undertake construction of this road, it will be, let's say, for example, in this case, 10 million. So the road is expected to take, let's say, for example, in this case, maybe 4 years. The road is expected to take 4 years. That is the project. That is the construction project. Is expected to take how many years? For 10 years. And of course, you've already known the costs. The total cost to undertake the construction of the road is actually 10 million. So under percentage of completion here, what normally happens at the end of each and every year, let's say, for example, the first year, we look at, in this case, what percentage have we completed the work? What percentage have we completed the work? And this one can actually be determined by, for example, utilizing the total costs and the cost to debt. Cost to debt. So in this case, 10 million by the end of, in this case, how many years? 4 years. But now in this case, at the end of the first year, you've already incurred costs, what? 4 million. So out of the 10 million, you've already incurred costs, how much? 4 million out of the 10 million. So we can conclude by the end of the first year here, the percentage of completion can be 4 out of 10, multiplied by 100%. So this one can end up having to help us to determine what is the percentage of the kind of work we've already completed by the end of the first year, whereby you take the cost to debt. So the cost to debt up to the end of 31st of December, the first year, is 4 million. So there's still 6 million remaining, which will be incurred in the subsequent 3 years. So we can use this method, for example, in this case, to know what percentage of the work has actually been completed. And of course, if this is the case, then this could be a way as to, in this case, they can determine how much they would end up having to pay you on the contract price. What percentage of the work have you completed for us to pay you the contract price? Maybe you already agreed the contract price could be 13 million. So they'll be able to know in the first year, they'll pay you 4 out of 10 of this percentage by 13 million, because that is the work you've completed. So this one, we end up having to account for it dependent upon, at the end of each and every year, what percentage of the work have you been able to complete? Have you been able to complete? And of course, this is actually the one you're going to look at, the computations. The computations, how you use the percentage of completion method to account for what? Long-term contracts, long-term contracts. So you can be able to write briefly about this percentage of completion method. So it is applied where the cost of the contract can be reliably estimated as the contract progresses. It is applied where the cost of the contract, it is applied where the cost of the contract can be reliably estimated, the cost of the contract can be reliably estimated as the contract progresses, we can reliably estimate the cost by the end of the first year will be 4 million as we progress. By the end of the second year, it will be 6 million as we progress. So if we can be able to reliably estimate at the end of each and every year what could be the cost we've already incurred, then we can use the percentage of completion method to undertake the accounting for our what? Our contract. To undertake the accounting for our contract. So the revenue, so in this case, the revenue, you can elaborate further and say the revenue and the gross profits is recognized as the contract progresses. The revenue and the gross profit, is recognized as the contract progresses. So the revenue and the gross profit is recognized as the contract progresses. So we can determine the revenue and the gross profit as the contract progresses. So because under percentage of completion here, the contractee, the person having to pay you, huyo mwenye unafanyia kazi, anaangalia first year umecomplete what percentage, anakukanja pesa, anakulipa. Hata kulipa pesa yote, mtakuwa mna progress tu akikulipa polepole mpaka vile the contract price mlikuwa mmeagree, mtamalizana kulipa. Kama mlikuwa mmeagree 14 million, so ataangalia 40% has actually been completed in the first year. So he will take 40% multiplied by the contract price, which is actually 14 million, then anakulipa hiyo. So second year pia anaangalia umemaliza kiasi gani, hiyo ndio atakulipa. So you can be able to recognize the revenue you are getting as a contractor each and every year, because the contractor is paying you on the percentage of the kind of work you've already been able to do what? To complete. Akulipi contract price yote in full, like under the other method whereby you have to complete fast so that you are paid once. Mara moja hiyo pesa papo ukishamaliza. Hii wanaangalia progress. First year umemaliza kiasi gani ya kazi, anakulipa. Second year umemaliza kiasi gani, anakulipa, as we progress like that. So you might find maybe you are paid 40% in the first year, the contract price. Second year you are paid 20%. Third year, maybe in this case, you are paid another 40%, or maybe in this case, another 30%. The final year, you are paid 10%. That is actually remaining to fully settle what? The contract price. So that's you're having to say in each and every year, actually, you can be able to recognize how much are you getting as revenue, because you are being paid the contract price. How much are you getting as revenue as the contractor as the years progress on like that, So in this case, the percentage of completion can be determined as follows. So the percentage of completion you can write the percentage of completion, can be determined as follows. Can be determined as follows. The percentage of completion can be determined as follows. So this is the formula which I had explained here briefly. You take the cost to debt. You take the cost to debt. You divide by the total cost or estimated total cost. You divide by the estimated total cost. You multiply by 100%. You multiply by 100%. Ile kitu nilikuwa najaribu kueleza hapa. Unachukua 4 out of the 10 million, you multiply by 100% because 10 million is the one required to construct the entire road. But by the end of the first year, the costs incurred on this construction of the road is 4 million. So you take 4 million, you divide by 10, you multiply by 100%. The cost to debt, which is 4 million, by the end of the first year, you multiply by the estimated total cost to construct the road, which is 10 million. You get 40% has actually been completed by the end of the first year. So that's in this case, you can actually end up having to determine what the percentage of the kind of work that has actually been completed. And that is what can actually end up having to be based upon to determine how much will the contractee, the person you are working for, maybe it is the government, how much of the contract price are they going to pay you? They look at what percentage of work have you completed. How can they be able to know? They can look at the cost you've incurred to date. They divide by the estimated total cost to construct the road. They know that in this case, at this particular point in time, you've completed probably in this case, how much? 40% of the work. 40% of the work. And remember, already you would have put a margin on the cost. So maybe in this case, they are supposed to pay you, like in this case, 14 million as the total contract price. So it means they'll take 40% of the 14 million. You'll end up having to be paid something like, let's say, for example, 4 point something, let's say 4.8 around there. So you'd have already gained like profit because you'll take 4.8 million minus the 4 million incurred as cost to know what could be the profit you've actually made on that kind of a contract in the first year. And of course, that is the kind of computations we are going to look at. The kind of computations we are going to look at. So now in this case, I want us to look at how we present. Before in this case, we take a break. Then we do the computations, the preparation of the financial statements. How will they look like if you are a contractor? Wewe ni contractor, unafanyanga mamijengo. How will you in this case end up having to present your financial statements to know what is the main objective? Number one, what could be my profit? Number two, what could be my work in progress by the end of each and every year as I go to another year when I'm working for someone in a contract? So presentation of the financial statements. Preparation and presentation of the financial statements. Je, zitakaaje? Zitakuwa zinakaa design gani? Zitakuwa zinatokea namna gani? Zitakuwa zinakaa design gani? So preparation of the financial statements. Preparation of the financial statements. So preparation of the financial statements. Preparation of the financial statements. Preparation of the financial statements. So we can start with the income statement. Itakaa namna gani? Income statement itakaa namna gani? Income statement, how will it look like? So the income statement, you will start with what we call the cost to debt. You can just write the cost to debt. It will look a bit confusing when we are looking at the presentation, but when you do an illustration, you will understand. You will start with the cost to debt, which I've briefly explained here. Cost to debt ni ile cost to income mpaka sahi, maybe by the end of the first year. So you start with the cost to debt. You add estimated cost to completion, estimated additional cost, you add estimated additional costs. You add it there. And then in this case, you'll be able to get the total cost. You'll get the total cost. You get the total cost. So this is actually what will actually end up having to help you to get, in this case, what you're calling what? The percentage of completion. The percentage of completion. The percentage of completion. The percentage of completion ambayo utachukua. So umeona kale ka formula tumefanya tu a while ago. Kalikuwa kanasema cost to debt over total cost multiplied by 100%. So this particular computation here will help you to know the percentage of completion. The percentage of what? Of completion. So ukishajua hivyo utaendelea. So utaendelea, close hapo, uendelee. So you continue in this case and now know what is the revenue. Revenue you are going to receive, revenue recognized. You know, determine the revenue you'll recognize. Revenue recognized. The revenue recognized. Then in this case, you less the costs to debt. The cost to debt ambazo ni hizi. Ile revenue umelipa. So unakumbuka na kwamba in this case huyo contractor atakuwa anaangalia kila every end of the year umemaliza kazi kiasi gani anakulipa. So hiyo ndio itakuwa revenue utakuwa unapata as a contractor. Then una minus dile cost will income mpaka hiyo place ya end of the first year ambayo ni hii hapa. Hiyo unapewa tu kwa swali. So you less this particular cost here. You less them here. You less them here. You'll get the gross profit. You'll get the gross profit for you as a contractor. Gross profit for you as a contractor. Gross profit to debt. Remember, gross profit ni yenye in this case umepata to the difference between revenue and the direct attributable cost to that particular kind of what a contract. But maybe in this case, wewe ni contractor mkubwa. Huko kwa ofisi yako kuna human resource, kuna employees wengine, kuna like admin expenses you incur to run your affairs. Wewe si contractor mchache, uko na ofisi kubwa sana in this case, uko na employees wengi, wewe ni kampuni kubwa. So in this case, apart from the cost you've incurred directly on that contract of constructing the road, there were other supporting staffs. Ulikuwa maybe una need transport kupeleka mzigo sijui hapa na pale. So when you get now in this case the gross profit, you must less those expenses for you to be able to in this case determine what could be your net profit as what? As a contractor. So in this case you'll end up having to less first of all there's this item here, but hii utaielewa saa ile tutafanya swali. Usianze kuuliza maswali mingi kuhusu less gross profit already recognized. Hii ni ya the previous year yenye shakuwa recognized, but utaiona kwa swali vile inaingiana. Gross profit already, you less gross profit already recognized. Already recognized. You less gross profit already recognized. You less it here. You less it here. You less it here. Then in this case, you'll get a figure here we call, you can continue here, just continue here. After that, you'll get a figure we call gross profit for the period. Gross profit for the period. You'll get gross profit for the period. Gross profit for the period. Gross profit, you'll get gross profit. The difference between this and this, you'll get gross profit for the period. Then on the gross profit for the period, now in this case, where you less now the general expenses. Hizo yenye nakwambia za transport, ulituma watu wa mizigo, ulikuwa na transport cost, admin expenses at the office, less general expenses. You less general expenses. You less general expenses, then you'll get the profit for the year, net profit for the year. Profit for the year, you'll get profit for the year. Ukishafanya your difference utapata profit for the year. Hii usiulize maswali mingi sana kuiuzo. Ni just the gross profit they have already recognized for the previous year. So kutakuwa na maybe 2015, kutakuwa na maybe 2016, maybe 2017. So there'll be that gross profit ambayo ni hii. There'll be that gross profit ambayo ni hii watakuwa washa recognize for 2015. Sasa kama hapa kwa 2015 ilikuwa 60 million. When you are preparing now the statement for the coming year 2016, sasa hii gross profit already recognized ndio inakuja hapo 60 million unaikuja na iweka hapa. If hapa the gross profit recognized in this case is maybe 40 million, when you are preparing for 2017, the gross profit already recognized, this item here, utakuja ubebe hii uiweke hapa 40 because it has already been recognized. So you have to less it from 2017. You cannot actually subsequently recognize it because you've already recognized it. So it is that gross profit which has already been recognized in the previous year. And of course, when you do a question now, in this case, you'll be able to see how in this case this gross profit already recognized arises, for you to be able to use it to know how much will be your gross profit before you less what? The general expenses. The general expenses. So that is ideally how in this case you'll be able to present your income statement. Your income statement. Your income statement. So I hope you've already completed writing. So have you completed? Because now in this case, I want to present to you how you come up with a statement of financial position. Before now in this case, we look at what? A question. Have you completed the writing? This particular presentation. This particular presentation. So this one is gross profit for the period. You less general expenses. You'll get profit for the year. You'll get profit for the year. So I can see Karen says yes. As you can see, Karen says yes. What about the others? What about the others? At least 4 or 5 people should be able to confirm that they have completed. I can see Mbuthia says yes. She's already done. Mbuthia, Alex says already he's done. I can see Ruth Nanjala says yes, he's already done. I can see Cheborgei. Cheborgei is here. Cheborgei is here. So now in this case, I want us we look at how you present the statement of financial position. How you present the statement of financial position for you as a contractor. How you present the statement of financial position for you as a contractor. How you present the statement of financial position for you as a contractor. So presentation of statement of financial position. So presentation, so we have in this case number B, the statement of financial position. Statement of financial position. Hii ni kama ni balance sheet. So here ni balance sheet. Or in this case, the work in progress statement. Work in progress statement. Work in progress statement. Kumbuka, pale tukianza, na hata narudia, hii statement nimerudia karibu mara ngapi? Mara 5 ama ni mara 6 ya sahi. The main objective under IAS 11, accounting for long-term construction contracts. Number 1 main objective is for you to determine you as a contractor, how much you've made as a profit. That one comes out where? In what you've just presented previously in the income statement. So umeona the last figure hapo tumepata nini profit for the year. Objective number 2 is for you to determine what could be your work in progress that you'll be working on the coming year. This one now, in this case, you get it in the statement of financial position. Statement of financial position. You get it in the statement of what? Financial position, which ends up having to become, like in this case, what? Maybe your asset. So in this case, to get the statement here inakanga a bit different. Usianze kuuliza mbona ifanani kama zingine. But now in this case, how you present it, you start with the cost to debt. Cost to debt. You start with the cost to debt because you want to get majorly this one, which is one of the main objectives we are accounting for this kind of contracts. So you get the cost to debt. Cost to debt. Then you add gross profits. Add gross profit. You add gross profit to debt. You add gross profit to debt. Gross profit to debt. Then you less the cash you've received. You less cash received. Cash received to debt. Ile pesa umeshalipo to debt. Cash received to debt. You less cash you received to debt. So this will actually end up having to give you the work in progress. Work in progress, the WIP. The work in progress. The work in progress will give you the work in progress. Work in progress. It will give you the WIP or the work in progress. Then another item you determine is the receivables or payables. The amount that in this case you've been overpaid, or in this case the contract is yet to pay you. It becomes a receivable. So what have you billed so far to the client? So total billings, you take total billings. Total billings to debt. You take total bill, what you've so far billed the client, you less cash you've received to debt. Ile pesa amesha kulipa to debt, cash received to debt. Maybe bill 6 million. Na akakulipa in this case maybe 8 million. So you can either end up having to be overpaid ama amekulipa less. So kama amekulipa less inamaanisha bado unamdai. So it will be a receivable. it will be a receivable. It will be a receivable. Kama in this case amekulipa more, atakuwa anakudai yeye. It will be a payable. It will be a payable. Kama umembill, let's say for example in this case umembill 10 million na end up amekulipa 15 million. So unaona hapa ni ukiless cash amekulipa inakuja negative. Hii inamaanisha ni payable. Yeye ndiye anakudai. Payables ni creditors. Hiyo najua mnajua haki. Hiyo si mnajua haki. Payable ni creditor. So kama amekulipa pesa mingi hiyo client unajengea, inamaanisha anakudai. So atakuwa payable. But if it happens umembill 10 million na amekulipa 8 million. Inamaanisha in this case there's a positive of 2 million. Sasa yeye ni receivable. Unamdai, si ndio? So ni receivable kwa books zako as the contractor. Ni receivable. So in this case itakuwa 2 million. So in this case if it happens you've less here and it is a positive, it becomes what? A receivable. Or it can be a negative which ends up having to become a payable in your books of accounts as what? As a contractor. So that's how in this case you present what? The statement of financial present for you to be able to determine what? The WIP. So inakaa hivyo and inaishia hapo. That is the extract. That is the extract. That is the extract of the statement of financial position. And the other one we've looked at is the extract of the income statement. So you can wind up writing it. Then after the break, we can have a break. We can have a break. After a break of 5 minutes, we are going to start looking at illustrations. We're going to start looking at illustrations. So you can just complete writing after 5 minutes. So we should be back by around 7:05. We should be back by around 7:05. Yes, so I think we can proceed. We can proceed. Confirm whether we can continue. Confirm whether we can continue. Confirm whether we can continue. Are we together? Can we continue? The break is over. Can we continue? Can we proceed? Can we proceed? Can we proceed? But I can see you are saying, yes, we can proceed. 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 So we can look at an illustration. We can look at some illustrations here, which I think will be quite enough. Which I think will be quite enough to enable us to cover this area comprehensively. Cover this area comprehensively. So so some of the questions that were tested a long time ago. So we're going to, instead of me having to tell you to check the past papers, you can write this. You can write this. You can write this. So illustration one. Illustration one. Illustration one. Illustration one. Illustration one. Then so you write, just write. So Jenga Construction Limited, Jenga Construction Limited, Jenga Construction Limited, Jenga Construction, like that, Jenga Construction Limited, Jenga Construction Limited was awarded a contract, on 1st January. Jenga Construction Limited was awarded a contract on 1st January 2006. Was awarded a contract on 1st January 2006. Then you put a full stop and say the contract price was fixed at. You're having to say Jenga Construction Limited was awarded a contract on 1st of January 2006. Full stop. Then you say the contract price was fixed at 120 million shillings. So the contract price was fixed at 120 million shillings. 120 million shillings. And the estimated total cost of the contract, you're having to say the contract price was fixed at 120 million shillings. And the estimated total cost of the contract was 105 million. And the estimated total cost of the contract was 105 million. So the contract price was fixed at 120 million and the estimated total cost of the contract was 105 million shillings. Full stop. The following information relates to the contract. The following information relates to the contract for the 3 years from, the following information relates to the contract for the 3 years from 1st of January 2006 to 31st of December 2008. So these are 3 years, 2006, 2007, and 2008. So the following information relates to the contract for the 3 years from 1st of January 2006 to 31st of December 2008, when the contract was completed. It was actually completed in 2008. When the contract was completed. So hope we are together up to there. Then you can prepare a table. After you've written that, you put a table. So on the table, just copy exactly what I'm going to put here on the board. Going to put here on the board. So we have in this case 3 years. So 2006. 2006, we have 2007, and we have 2008. 2008. So of course, our shillings, we can put them in thousands. Our shillings, we can put them in thousands. Our shillings, we can put them in thousands like that. In thousands like that. So on this table, you can start with the cost incurred. Cost incurred. Cost incurred. Then we have estimated further costs. We have estimated further costs. We have billing to clients. Billing to clients. The billings to clients. We have collection from clients. Collection from clients. Then we have, in this case, administrative expenses. Administrative expenses. Administrative expenses. So then in this case, for the cost incurred for the year 2006, this one is 20. This one is 70,000. This one is 30,000. 30 million. This one is 12 million. This one is 2 million. 2 million. Then on 2007, so for this one is 42 million. This one is 36 million. 36 million. This one is 50 million. This one is 38 million. This one is 2.5 million. Then in the last column, so the cost incurred to date is 32 million. There's nothing here. There's nothing there. Estimated further costs were not there in the final year because they completed it there. This one is 40 million. This one is 60 million. This one is 1 million. 1 million. So you can prepare the table. So they make sure they are aligned. Mine on board, we might be seeing they are not aligned, but I think they are aligned. So I think they are aligned. I think my handwriting, it's okay. I think you can be able to see it. I can see it is very clear. So kindly copy, because we want now to start looking at how do you come up with now the final statements here. The final statements here. So I can see Nanjala says, I repeat. So first of all, Nanjala, copy this table. Hope you've left some space. I'll repeat it very quickly. Then I think we start the computation. So copy this particular table here. The table, copy the table. I repeat the table, but the table is here. I repeat the table, Joseph, but the table is here. Copy the table. Copy the table, or I reread the table. So this one is cost incurred, estimated further costs, billing to clients, collection from clients, administrative expenses. So I think for the figures, you can be able to see. This one is 20 million. This one is 70 million. This one is 30 million. This one is 12 million. You know, it is million because there's this one up here. So kiongeza hizo hapo inakuwa million. 12 million, 2 million. This one is 42 million. This one is 36 million. This one is 50 million. This one is 38 million. This one is 2.5 million. This one is 32 million. This one is 40 million. This one is 60 million. And this one is 1 million. That one is 1 million. That one is 1 million. So I don't know whether you've completed the table. Have you completed the table? Have you completed the table? I can see Joseph says, yes, completed. Yes, completed. Ruth says yes. So I had said the first statement before we went to the table. Jenga construction, Limited was awarded a contract on 1st of January 2006. The contract price was fixed at 120 million and the estimated total cost of the contract was 105 million. So the contract price was fixed at 120 million and the estimated total cost of the contract was 105 million. Full stop. The following information relates to the contract for the 3 years from 1st of January 2006 to 31st of December 2008. Then we had the table. We had the table. So after the table, you can now in this case indicate what they are required of us. What are we required to prepare? Required. You can indicate the required now. The required. For each of the 3 years, prepare. For each of the 3 years, prepare. Number 1, for each of the 3 years, prepare required. For each of the 3 years, prepare number 1. For each of the 3 years, prepare number 1. An extract of the income statement. Extract of income statement. Extract of income statement. Number 2, extract of statement of financial position. Extract of statement of financial position. Financial position. Extract of statement of financial position. Financial position. Extract of statement of financial position. Extract of statement of financial position. So hope that is okay. So I think we can now, in this case, I can rub here so that we can start looking at the answer. We can start looking at the answer. So the answer very quickly. So you can start looking at the answer. How do you now, in this case, come up with? Remember, I've given you the format for these two. Niyo tumeandika, hiyo format tumechora tu before tuende break. So ndio tunataka to apply hapa kupata those figures that were there. The figures that were there. So we can start in this case by having to look at the income statement. We can start up by having to look at the income statement. So the solution or the answer. So we can look at the answer. So the answer, we can look at the answer to our question. And of course, now in this case, we are going to start with the first one, Roman 1. So Roman 1. So you can remember the format. The format hapo ya niliwaambia ya income statement. Nilikuwa nimesema in this case tutaanza na, of course there are 3 years. Remember tulikuwa tunasema the objective hapa ni kujua in each and every year as a contractor ulikuwa unatengeneza how much revenue, how much profit, what was the work in progress. So there are 3 years here. There are end of 3 years here. End of 3 years here. So first of all, in this case, we'll be able to determine the percentage of completion. The percentage of completion of our work. So that in this case, the percentage of completion will, for example, in this case, enable us to know how much will we be able to recognize as revenue. Remember the method, ile nimekuwa nikiimba, ile method number 2. Nikakwambia in this case, kuna method ingine inaitwa percentage of completion. Under percentage of completion, lazima tujue cost to date, to divide by the total cost, tujue u contractor alikuwa amemaliza kazi kiasi gani. So that in this case, ile pesa analipwa, it will actually be dependent upon how much he has actually completed as work. So that's why in this case, nilikuwa nimewaambia, unaanza na cost to debt. Then in this case, you add the estimated additional cost or further costs. Additional costs. For example, you have to estimate like how much further costs or how much cost are we still having to be needed in this case to, for example, put in, so that in this case we can actually end up having to do what? Complete the project. So in this case, if you look at our question, you are told for the year 2006 from the table, the cost incurred in the year 2006 ilikuwa 20 million. Ilikuwa 20 million. And the cost incurred in the year 2007 ilikuwa 42 million. So wacha niulize swali. So according to you, what do you think will be the cost to debt by the end of the year 2007? What do you think will be the cost to debt by the end of the year 2007? So of course unaambiwa the cost incurred in the year 2007 ilikuwa how much? 42 million. So what do you think will be the cost to debt by the end of the year 2007? What do you think will be the cost to debt by the end of the year 2007? I can see Nanjala says 62 million. 62 million. Chebroge, say something. Do you think it is 62 million? Do you think it is 62 million? Ukiangalia table, wamesema costs. The costs incurred in the year 2006 ni 20 million. Cost incurred in the year 2007 ni 42 million. But hapa kwa hii table yetu tunasema cost to debt. So cost to debt for the year 2006 tumesema ni 20 million. What do you think will be the cost to debt for the year, in this case 2007? Of course, Nanjala is correct. Itakuwa 62 million. Utachukua 20 million, uongeze the cost that were incurred in the year 2007. Remember, those are the costs incurred for the specific year. Mwaka ya kwanza ala incur 20 million. Mwaka ya pili aka incur 42 million. So we are looking at cost to debt. Cost to debt. Cost paka sahi. Cost paka sahi. Inamaanisha in this case itakuwa 62 million. 62 million. So therefore it means in the year 2008 itakuwa ngapi? Sasa hapo in this case Mbuthia unaweza tungaria. Mbuthia unaweza tungaria. Unaweza tungaria hapo, kwa hiyo 2008 itakuwa ngapi? 2008 itakuwa ngapi? Mbuthia itakuwa ngapi? Chebroge says 94. 94 itakuwa 94, so itakuwa 94 million. Itakuwa 94 million. Then the estimated additional costs zile tumeambiwa estimated additional costs that might end up having to be incurred for the year, in this case 2006, they might end up having to incur further 70 million as the costs. And in this case, for the year 2007, they'll incur further costs of 36 million. But hapa kuna sindio. So inamaanisha in this case, the total costs in the specific, the total costs here, this one will likely be 90 million. This one will be 98 million. 98 million. This one will be 94 million. Will be 94 million. 94 million. So there can't be estimated additional cost here, kwa sababu project inaishia hapo. Uwezi weka tena cost zingine. Sasa hizo umetoa wapi wewe? Umetoa wapi wewe? So in this case, this one, with these particular figures here, then we can be able to get the percentage of completion of this work. Percentage of completion of this work. And remember, kale ka method. So unakumbuka hiyo method number 2. Nikawapea formula ya kupata percentage of completion. Tukasema unachukua in this case cost to debt, una divide by the total costs. Cost to debt una divide by the total costs. Sinamaanisha in the first year 2006, for us to know the percentage of completion, hatu unaweza eka ka formula hapo. Hilda, unaweza sema cost to debt divide by total costs. Total costs divide by total costs. Sinamaanisha hapa Ruth hapa itakuwa 20 over 90 multiply by 100. Nimeka nini? Hii ni 20, nimechukua to the first figures. 20 over 90 multiply by 100%. Hii utachukua in this case 62 divide by 98 multiply by 100%. Multiply by 100%. Hii utachukua 94 over 94 multiply by 100%. Multiply by 100%. Multiply by 100%. Multiply by 100%. 100%. So what are you getting as the percentage here in the first year? What are you getting as the percentage here in the first year? Percentage of complete. I can see you are saying 22.22. So you can just round off. You can just round off and say 22. Just say 22%. Just say 22%. What about the second year? Unapata nini? Second year unapata nini? Second year. I can see you are saying 63. So 63%. 63%. What about the third year? Third year, current poll. Third year, current poll. Third year, 100%, 100%, 100. You can see in the third year tumemaliza kazi, si ndio? Si ni 100%, so unaona tumecomplete, tumefinish. Ni kufinish kumalo hapa, ni kufinish kumalo hapa. Unaona hapa ni tumemaliza project. Unaona hapa baada tumefika 63%, hapa tumefika 22%, hapa tumefika 63, hapa tumefika 100. So ni kufinish kumaliza, so tumemaliza 100%. So that is the percentage of what? Of completion. This one actually we compute it so that in this case we can be able to know how much will we be able to recognize as revenue in our books of accounts. Remember, revenue tushaambiwa, si ndio? So tushaambiwa revenue ni ngapi? Ilikuwa 120 million. Unakumbuka the first paragraph that in this case Jenga Construction Contract Limited was awarded a contract on this debt. The contract price was fixed at 120 million. That was the price the contractor was to be paid. That was the total revenue he was supposed to get. But unasema under percentage of completion hawakulipangia 120M yote. Wanaangalia umemaliza kazi kiasi gani, so that in this case wanaweza kulipa portion by portion until the 100% is done, what is actually completed. So these particular percentages of completion help us to know how much out of that total amount to be paid as revenue we will be able to recognize in each and every year as revenue. Kwa sababu tukianza kuongelea mambo ya kudetermine profit, lazima tujue revenue yetu kwa kila mwaka ni pesa ngapi. Therefore, in this case, we can actually end up having to continue now in this case and actually come up with now the hapo mmemaliza hapa mmemaliza, si ndio? Mshamaliza. Nikumaliza. So in this case, we can now come up with the already determine the revenue recognized, the revenue to be recognized. You can in this case determine the revenue to be recognized before in this case we start looking at, so we can say revenue to recognize, revenue to be recognized, You can just write under that particular table you've constructed, you say for 2006, you say 22% multiplied by 120 million. For 2007, you say, is it 63%? 63% of 120 million. 2008, you say 100% of 120 million. So 22% of this, what are you getting as the revenue to be recognized? 22% of this, what are you getting as the revenue to be recognized? Revenue to be recognized, 22% of that. 22% of this, you're getting, unapata ngapi? Of 120 million. 26.4. So 26.4, you can put your figures in thousands. So this can be shillings in thousands. It will be easy when you put them in thousands, shillings in thousands. Just continue with that table you had, so that after this is when we can now. So it is 26,400. So it is 26.4 because of this. Tuongeza hapa tatu. 63% of 120. 63% of 120 unapata ngapi? 63% of 120. 63% of 120. 75,600. So 75,600. 75,600. Then this one is quite obvious. It is 120 million. This one is quite obvious. It is 120 million. 120 million. So we can now, in this case, come up with the income statement. So the income statement, we can construct the income statement now. We can now construct the income statement after that working. For the income statement, still put the years. Put the years. So put the years on the income statement. You can put the years on the income statement. So or you can put, let's try to make our work presentable a bit. So you can put a heading, Jenga Contractors Limited. Jenga Contractors Limited, income statement extracts. Income statement extracts. Income statement extracts for the year ended. 31st of December, 31st of December. But now we have 3 years. So we have in this case 2006. We have in this case 2007. We have in this case 2008. 2008. So our shillings are actually in thousands. So shillings are in thousands. So shillings in thousands. Shillings in thousands, like that. Shillings in thousands, like that. Then, so remember the format of the income statement. Ile nilikuwa nishawapea. Tulikuwa tumesema tunaanza hapa na revenue recognized. Revenue recognized. Hiyo tumecalculate hapa. Current poll ndio hii haki. Tusianze kusema hii tunatoa wapi. Ruth na Njala. Tusianze kuuliza tunatoa wapi. Tumecalculate hapa. Ile tulikuwa tunatumia percentage of completion kuipata. Ndio hii tusha compute hapo. Ni 26,400. Yaani unazibeba tu. Sasa hii ni kubeba tu mafiga. Ni kubeba tu mafiga na kuzieka. Haki inakaa rahisi. Inakaa rahisi. So revenue recognized. Then tukasema you less the cost to debt. Remember that format. Less the cost to debt. Cost to debt. Cost to debt pia iko hapo kwa hiyo table iko hapo juu. Before this computation kuna hiyo cost to debt. In the first year ilikuwa 20 million. Alafu ingine ile ilikuwa inatusumbua sisi na Hilda. Unakumbuka ile imetusumbua na Hilda. Tunashangaa ni 42 ni 62. Ndio hiyo tushaipata ilikuwa 62. Ilikuwa 62. Then ya mwisho ilikuwa in this case 94. Si ilikuwa 94, si ndio? 94. So you less the cost to debt so that you can be able to get the gross profit to debt. The gross profit to debt. You can get the gross profit to debt. So here unapata hapa 6,400,000. Hapa utapata, is it 13,400? Is it 13,400 or 12,400? 13,600. You get 13,600. Yes, 13,600. So hapa utapata 26 million. 26 million. Then tukasema, sasa hapo ndio ile nilikuwa nawaambia utaelewa tu tukifanya the example. Unakumbuka ile niliwaambia utaelewa tu tukifanya an example. Less gross profit to debt. Ile na Njala karibu aanze kuniuliza maswali mengi. Hiyo ni gani sasa less gross profit to debt ni gani hiyo? Less gross profit to debt. Unakumbuka ile nilikwambia utaielewa tu tukifanya example. Nikakwambia unachukua ya the previous year. Unaipeleka the coming year. So hapa gross profit to debt haitakuwa. Je, unafikiri ya 2007 itakuwa gani? Gross profit to debt ya 2007 itakuwa gani? Current poll. Gross profit to debt. Remember in our format, less gross profit to debt. Nimesema hapa hakuna. Ya 2007 itakuwa gani? 6.4. Sio 64 wewe Joseph Okoth. Ni 6.4. 6,400 itakuwa hii. So tumesema tuna less. Alafu ya hapa itakuwa 13,600. Itakuwa 13,600 like that. 13,600 like that. So you get gross profit for the period. So the GP for the period. GP for the period, you'll get here it is 6,400. This one, you get the difference. You get the difference of this one. This one will be 7,200. This one will be 12,400,000. Then in this case, you less admin expenses. Tumesema wewe kama ni contractor inamaanisha kuna kampuni. You're not basically operating a briefcase company, but you have a company where you've employed people. So there are those admin expenses you might end up having to incur. Hizo tumepewa. Tumepewa the last item as admin expenses. So you less the admin expenses. Hope hapo mnaona. Admin expenses. You less the admin expenses. For the first year, you've been told the admin expenses were 2 million. 2 million. For the second year, they were 2.5 million. For the third year, they were 1 million. So you get the difference. So you less these ones. You less all these ones so that you can be able to get the net profit for the year. So the profit for the year, the last figure you'll be able to get here is profit for the year. Profit for the year. So this one is 4.4 million. This one is 4.7 million. And the last item there is 11,400,000. So that is the profit for the year for this particular contractor. For that contractor, naona hapa money. That is any better? I think that is a bit better. I think you can be able to see there. So 11,400,000. So that's why in this case you come up with the income statement extracts. You come up with the income statement extract. So I want us now in this case we look at the statement of financial position extract. I want us now in this case we look at the statement of financial position extract. How will it look like? How will it look like? Statement of financial position extract. So hope you finished writing this one because I want to wrap. So 𝐂𝐿 Contractors Limited. So 𝐂𝐿 Contractors Limited. 𝐂𝐿 Contractors Limited. Statement of financial position extracts. Financial position extracts. Statement of financial position extracts. As at we have 3 years. We have 3 years. We have 2006. 2006. We have 2007, and we have 2008. So 2008. Our figures are in shillings of thousands. They are not cows. They are shillings. They are not cows. They are shillings. They are not cows. You need to put their shillings in thousands because what you are dealing with here ni pesa. It is money. It is not cows. So in this case, we said for this particular statement of financial position extract, what unaanza na nini? Unaanza na item gani? Unaanza na item gani? Tuseme unaanza na item gani? From our format, tulisema unaanza na which item? Which item? You start with which item? When you're coming up with the statement of financial position extract, you start with which item? Cost to debt. Cost to debt. So at least I can see Irene is following. Irene anafuatilia chenye kina happen hapa. Anafuatilia. So we start with the cost to debt. Na cost to debt haifai kupea kizungumkuti. Sikulete ngori. So unaenrudi pale juu penye tulikuwa tushaanza na ile calculation ya kwanza, unabeba hizo mafiga ukiziplug hapa. So the first one was actually 20 million. Ile ilikuwa 62 million. Mwisho ilikuwa 94, si ndio? 94 million. So unazikumbuka tulizicalculate tukianza safari. Then you add the gross profit to debt. Gross profit to debt. Hii pia umedetermine in the P&L, in the income statement hapo juu. So the gross profit to debt yenye come up in the, it is here. Nimeirab lakini. Nimeirab ndo hii ilikuwa hapa. So gross profit to debt. In the first year, it was actually 6.4 million. Second year, it was actually 13.6 million. And in the final year, it was 26 million. 26 million. So then in this case, you add, so this one you add, sorry, you add the gross profit to debt, then you less the cash received, less cash received to debt. Cash received to debt. The cash you've received to debt. So less the cash received to debt. Cash received to debt, if you check the question iko hapo. Unaona hapo collection from client. Collection from client kuna 12 million, 38 million. Then kuna 12 million, 38 million. Then kuna 60 million. So collection from the client. So in the first year, they collected 12 million. they collected 12 million. So remember, this one is to debt, current poll. This one is to debt. Na ile umepea hapo kwa swali, wanakuambia collection from the client. So in the year 2006, they collected 12 million. Year 2007, they collected 38 million. So to date, inamaanisha tuta add. So tutachukua 12 million plus ile wali collect 2007 ni 38 million. So itakuja ngapi in this case? Itakuja 50 million. Then in the final year, they collected 60 million. So you'll add, itakuwa 110 million. So tuko pamoja. Tunasema ni to debt. Ile yenye tumepewa kwa swali ni ile walikuwa wanapata specifically in that year. But here what you less is the cash that has actually been received by you as the contractor to debt mpaka saa hii. So mwaka ya kwanza walikupea 12 million. Mwaka ya pili wakakupea 38 million. So inamaanisha by the end of the second year, if you add the amount for the previous year, walikuwa wamekupea 50 million. In the final year walikupea 60 million. By the end of the third year, walikuwa wamekupea in total pesa ngapi? 110 million. 110 million. And therefore, in this case, with this, we can be able to know what could be our work in progress. So our work in progress. So our WIP, work in progress. So if you get the difference there, you should be able to get 14,400. This one will get 25,600,000. The work in progress for the second year is 25,600,000. The work in progress in the final year, it is 10 million. Unaweza fanya the mathematics haraka. 94 plus 26 minus 110. This one, when you add, is 120, which is the contract price. So you add this one, you also less, you'll get 25,600. You add this one, you less, you'll be able to get 14,400. So with this now, in this case, what you're calling what? The work in progress. The work that is actually still having to continue for you as what? As a contractor. Then we want in this case to get either the receivables or what? Or the payables. So in this case, to get the receivables or the payables, you take the total billings. How much has the contractor billed? The total billings to debt. Total billings to debt. Na kwa swali wametupea nini? Kwa swali wametupea, in the question they have given us billing to clients. So billing to clients in the first year, it was 30 million. It was 30 million. In the second year, it was actually billings to debt, it will likely be 80 million. So you can underline this one, to debt. So like that. So you need to be careful with that, to debt, with that to debt. So you need to be careful with that to debt. So this one is 30 million, this one is 80 million. Then the final year, it will likely be 120 million. Then in this case, you less the cash you've received to debt. So the cash received to debt ni yenye iko hapa juu. Hiyo tunapick tu hizo figures iko hapo juu. So the cash received to debt. The cash you've so far, the client has been paying you. So in the first year already ashakulipa 12 million. In the second year ashakulipa 50 million. Hii hapa ndio hii tulikuwa tushapata hapa. Unazipick tu unazokuja unaziweka 50 million. In the final year alikuwa amekulipa to debt, alikuwa amekulipa 110 million. So with the difference, I told you, if it happens, you've billed the client na amekulipa pesa less, hiyo ni receivable. So in this case, we can get our receivables or payables, of which in this case, all of them are coming to be receivables. This one is 18 million. What you are claiming from the client yenye hajakulipa, kwa hivyo ni receivable yako. So ule mtu unadai ni debtor, so ni receivable. So in the balance sheet ni receivable, ndo hiyo 18 million. Alafu hapo umembill 80, amekulipa 50 peke yake, you may collect up to 50 peke yake. So inamaanisha by the end of this year, what you are claiming from him, it is 30 million. 30 million, exactly 30 million. And in the final year, it is 10 million. What you are still claiming from him, it is actually 10 million. So hope we are together up to that particular point. And there's something very interesting here. that you must actually be able to note current poll. You can see this figure is same as this figure. Current poll. Unaona hapo hiyo mambo. Unaona hapo hiyo mambo. Hii work in progress. Work in progress inamaanisha ni ile kazi contractor hajamaliza. So by the end of the year 2008 bado hajamaliza kazi worth 10 million. Inamaanisha hii pesa bado anadai. So receivable yake itakuwa 10 million. So akimaliza ndio atakuja lipwa. So unaona ziko the same. Ziko the same. So hii hajamaliza by the end of 2008. So inamaanisha probably as per the contract price, he is still having to claim from the client 10 million because he hasn't done that work. So that's why in this case, the receivable here, you can also be able to see it is 10 million, 10 million. So that is how basically in this case, you come up with the receivables and of course the WIP. But I told you if it happens that what you've billed the client, he has ended up having to pay you more, then it won't be a receivable, it will be a payable. For example, kama hii figure inakuja inakuwa negative, inamaanisha huyo client ndiye anakudai. So it will likely be in this case be what? Be a payable. Anaweza fika mahali ya make mistake akulipe pesa mingi. Ama ana kulipa mapema, hataki story zako, anamalizana na wewe mapema. So atakuwa amekuwa overpay, yeye ndiye atakuwa anakudai sasa umfanyie kazi. So it will be a payable. So that's why in this case you come up with what? The extracts. The extracts for each and every year. 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 So there's another one which I want us we also look at. There's another one which I want us also we look at. So you can be able to write it. Just write it. Write it. We'll be able to look at it tomorrow. This one I'm going to leave. We'll be able to look at it tomorrow. Then or you can just attempt it as an assignment, but we'll look at it before we start the other area. We'll look at it tomorrow. You can write it. You can just write it as we wind up the class. You can write it. So illustration 2. So you can try to attempt it, but we'll look at it tomorrow also together in class as the first thing. So you can write on 1st of January 2014, 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 comma, Ujenzi Limited, Ujenzi Limited was awarded a contract for the construction of a road. On 1st of January 2014, Ujenzi Limited was awarded a contract for the construction of a road. Full stop. The contract was for 3-year period. The contract was for a 3-year period. The contract was for a 3-year period. A 3-year period. Full stop. The contract price was 250 million. The contract price was 250 million. The contract price was 250 million. Full stop. The following information has been extracted from the books of Ujenzi Limited. The following information has been extracted from the books of Ujenzi Limited for the 3 years. The following information has been extracted from the books of Ujenzi Limited for the 3 years. So you put a table. So we have 2014. We have 2015. We have in this case 2016. So so of course our figures are in shillings of millions. They are not cows. They're in shillings. They are figures which are in shillings of millions. What you are presenting here as figures, they are not cows, but they are actually, it's pesa. Si ni watu wa pesa. Si tunaongeleleanga mambo ya pesa. We are not talking about injection of cows. We are not talking about injection of cows. So total, we start with total cost incurred to debt, cost incurred to debt, total cost incurred to debts, total cost incurred to debt, you know, the first item there. Then estimated additional cost to completion, estimated additional costs to completion, estimated additional cost to completion, then billing made during the year on the contract, billings during the year, billings during the year. Then the other item is cash received on the contract, cash received on the contract, cash received on the contract. Then the last item is general administration expenses, general admin expenses, general admin expenses. Total cost incurred to debt. So for this one is actually 80. I can adjust my table a bit so that it fits so well. So we have 2014, 2015, and of course 2016. So here it is shillings of millions, shillings of millions, shillings of millions. So now we can insert the figures. Hope you've written this. So total cost incurred to debt, estimated additional cost to completion, billings during the year, cash received on the contract, general admin expenses. So tunataka kuanza kuweka figures. So hapa total cost incurred to debt, hapa ni 80, hapa ni 170, hapa ni 220. Higher estimated additional costs to completion is what this one is 120 million, this one is 90, and this one there's nothing there. Billing made during the year on the contract is actually, this is actually 90, this one is 100, this one is 60. Then cash received on the contracts, he received here 80 million, here he received 90, here he received 70. Then general admin expenses, here they were 4 million, here 6 million, and here they were 5 million, 5 million, 5 million, 5 million, 5 million. So you can finish the table. Inform me whether you've already finished up writing the table so that we wind up on the question. So that we wind up on the question. We wind up on the question. Just tell me whether you've finished up with drawing the table so that we wind up with the final part of the question. Joseph Okoth is done. Karen Paul is done. Ruth is actually done. Ruth is done. Chebroge, where is Chebroge? Chebroge, 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 Chebroge. Alex is done. So Irene is done. So that's quite okay. So Chebroge seems, Chebroge is still here. He says done, done. So we can write this required. What are we required of in the question? Required. What are we required of in the question? Required of in the question. Using the percentage of completion method. Using the percentage of completion method. Using the percentage of completion method. Prepare the following. Using the percentage of completion method, prepare the following. Semicolon. Number 1, income statement extracts for the 3 years. Income statement extracts for the 3 years. That is Roman 1. Income statement extracts for the 3 years. Then Roman 2, statement of financial position. Statement of financial position as at the year end. As at the year end. Statement of financial position extracts. Statement of financial position extracts as at the year end. as at the year end for the 3 years, as at the year end for the 3 years, as at the year end for the 3 years, So you can try to attempt it on your own as an assignment before we meet tomorrow. Just note that the only difference iko hapa. So kumbuka kwa ile ingine walikuwa wametupea cost incurred. Unakumbuka kwa ile ingine? But hii washatutengenezea cost incurred to, washatutengenezea. Unaona hiyo maneno? Unaona hiyo maneno? Alex, unaona hiyo maneno? Kwa ile ingine walikuwa wametupea tu cost to debt. Wametupea tu cost incurred, sorry, in the year. But hapo wametutengenezea mumbles. Washatufanyia cost incurred to debt. Washatufanyia cost incurred to debt. Washatufanyia cost incurred to debt. So washatufanyia cost incurred to debt. So atuta compute. So tukianza kucalculate percentage of completion, so cost to debt washatupatia. So when you start preparing now the computation, for example, for the income statement, hauta add. Unakumbuka ile ingine tulikuwa tuna add ya the first year na ya hii, alafu ya hii tuna add ya hii, ndio tunapata the cost to debt. Hii washatu compute, they have already computed for us. So that is, I think, the major difference that you'll be able to see, but you can be able to try to attempt it. Then also, there's May 2019, still under assignment, May 2019 question number 4. Look at this one also. We might look at both of them tomorrow, but look at this one also as an assignment. Look at this one also as an assignment. May 2019 question number 4. May 2019 question number 4. So I think we can end there for today. We can say hooray for today's class. So when we wind up in our tomorrow's class, remember I'm focusing on topic number 2. So tomorrow when we wind up, we look at hire purchase, accounting for hire purchase contracts. I want as we complete topic number 2, then I think we'll be able to go back to topic number 1. We look at current and deferred tax and leases. We look at leases. Then I think we'll be moving on so well. Under topic number 1, what we have as computations is leases, then current and deferred tax. These are the areas I think it is a theory. It is theory. So I want us tomorrow, when we wind up with the construction contracts, we look at hire purchase. Otherwise, I can just wish you a good night. So let's catch up tomorrow. Try to attempt that question. We look at it before we start looking at hire purchase contracts, how you account for hire purchase contracts. Any burning question you can be able to ask. Before we say hooray. So I can see Karen Paul says thank you. You are so much welcome. So if there's no any other concern, then have a good night. Let's catch up tomorrow.